While most textile stocks are under pressure due to a slowdown in the US and Europe, there is one textile company that has outperformed exceptionally. Raymond is a 97-year-old business with a strong presence across multiple sectors, including textile, apparel, garment, shirting, engineering, real estate, deriving about 80% of its total revenues within the country. Now, this particular company has given exceptional returns, outperforming Nifty 50, with the stock generating a return of more than 90% as against a 4% rise in Nifty 50 over the last 1 year. In fact, the company's shares gained more than 50% in just over 1 month. So what exactly is fueling this fabulous outperformance? We've all come across the very famous tagline, Raymond the Complete Man. Now, this company is known for its brand reputation and product quality. However, the company went through a period of slow growth, but they restructured their entire business, focusing on streamlining operations, improving their inventory management, and reducing their debts. And if that wasn't enough, they even ventured into real estate business with a great start. Now, these changes have also been reflected in the company's financial performance. Now, according to Raymond, the company has delivered record-breaking performance in revenue and profitability in the last 5 quarters. The company has also seen significant improvements in operating margins across all sectors, including their real estate business, which has achieved an impressive operating margin of 20.8% in fiscal year 22. Now, the textile, apparel, garmenting, and shirting businesses have all seen improvements too. Moreover, the management's efforts to enhance collections and efficiency in inventory are also paying off. Now, this is reflected in the reduction of net working capital days, which is the number of days a company needs to convert its working capital into sales revenue. Now, do know that a lower number of net working capital days is always better for a company. In the December quarter of 2022, Raymond's NWC days decreased by approximately 45% to 55 days compared to 98 days in September 2019. Now, the company has also made efforts towards reducing its debt, which decreased to 932 crore in the December quarter. Now, other triggers for the stock were 2 massive developments that happened yesterday. Raymond exited from the consumer care business by selling Kama Sutra and Park Avenue brands to the Godrej Group for Rs 2,825 crore in an all-cash deal. Now, even before the deal was finalized, the anticipation of it caused the stock to jump up by about 9% yesterday. Now, although Raymond is exiting the consumer side of the business, it will still continue to manufacture and sell these products to B2B customers and also export. Now, secondly, Raymond announced that its consumer-facing lifestyle business will be demerged into a new entity called Raymond Consumer Care, which will be listed upon merger. Now, this means that after the demerger, the company will have 2 independent entities, one for lifestyle products under Raymond Consumer Care and one for real estate business under Raymond, which is already listed. Now, it is clear that Raymond is undergoing a significant transformation. Now, with the positive growth outlook in the apparel and real estate sectors, the company's performance has been on an upward trend. Raymond is also leveraging India's consumption story and the trend towards branded clothing to boost its sales. Now, all of these developments are contributing to Raymond's makeover and making it an exciting company to watch in the future. Now, we want to hear your opinion on this 97-year-old business. Do you think Raymond is primed for continued growth, or has it already hit its peak? Do let us know in the comment section. Amid the recent bank failures, the talks of recession in the US are becoming more prominent. Adding to this, US released its GDP figures for the first quarter of 2023, revealing a slow growth rate of 1.1% compared to 2.6% in the previous quarter. Now, this was again lower than the expected 2% growth rate by economists. Now coming to the breakdown, personal consumption, which accounts for 68% of the US GDP, maintained a growth of 3.7% compared to a growth of 1% the previous quarter. Now government spending and exports also maintained a healthy uptick. However, there are signs of strains, especially in the sectors most sensitive to higher borrowing costs, such as residential fixed investment and business spending. Now, the slowdown in the US economy is the result of the Federal Reserve's efforts to curb inflation through multiple interest rate hikes over the past 1 year. Although inflation has reduced from last year's record high, it still remains well above the Fed's target of 2%. Now, while consumer spending is still on an uptick, the question of its sustainability still remains. Therefore, the US economy is currently experiencing both high inflation and a slowdown in GDP growth. So what does this news mean for you? The US economy faces risk from monetary policy tightening and global economic challenges. Despite growth in certain sectors and strong consumer spending, the sustainability of this growth is a concern. This will have an indirect neutral impact on you. While I say this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.